Hi, I'm Dave Gordon. If you're a stock trader, a retail stock trader, and even if you're not, if you're just thinking of getting into it, well, first of all, it's a smart thing to do because right now the only game in town is equities. Bonds are earning nothing. If you give your money to a bank, they're making 8, 10, 15, 20% on your money and paying you 2 or 3%. So if you're getting into stocks, smart thing. Now, this is a short video and you have everything to gain, nothing to lose. I'm not selling anything. I just want you to potentially sign up at the redneckstocktrader.com and get a host of free videos. But right now we want to talk stock analysis. There's two types of stock analysis: fundamental, technical. Fundamental analysis is all about the company. Technical analysis is all about the stock. Okay, let's look at fundamental analysis. You do not, repeat, do not have to be an accountant to understand at the very top level what a balance sheet is. A balance sheet is a snapshot of a business that gives you the value of the company. And guess what? You do it every day with your mortgage. The formula for a balance sheet is assets minus liabilities equals equity. So let's assume you bought a house for $200,000. You put $50,000 down. You have a mortgage for $150,000. All right? The equity you have in the house when you first buy it, obviously, is the cash you put down, $50,000. Because if you sell a house, you've got to take the $150,000 and pay it back to the bank because that's what it costs for your mortgage. Now, let's assume you live in the house for 3 years, and then you say you got to transfer to Calgary or you got to transfer to Miami. You got to move. You sell the house, and you actually get $250,000 for the house, and you sell it not on real estate, so all the money comes to you. All right. Well, you paid $200,000 for the house. You sold it for $250,000, so there's $50,000. Then you put $50,000 down payment. You put that together. Your equity is actually $100,000. Your mortgage is $150,000. You deduct that from the price that you sold it for, $250,000. $100,000 is yours. Gives you the value of the equity you have in the house. A business balance sheet is exactly the same thing. Assets minus liability equals equity. Now, you take the cost of goods sold out of the balance sheet because that's a snapshot, and you put that on the income statement. The income statement is not a snapshot. The income statement tells a story between point A and point B, and it tells you whether you're making money. So, for example, you may, let's take guitars for example. It may cost you $50 to make a guitar, right? Now you sell the guitar for $100. So that means you're making money. No, doesn't mean you're making money. The cost of manufacturing the guitar is $50. You sell it for $100. But guess what? You pay your salesman, you pay your distributor $60. So you're actually in the hole $10. The income statement tells you that. The income statement basically tells a story between point A and point B and says, this is what it cost me to sell the product. It's expenses. It's not rocket science. It tells you whether you're making money. Now, some companies, you look at their balance sheet, they're losing money. But if you look at you look at their income statement, they're losing money. Look at the balance sheet, and you say, wow, this company's worth a lot of money, even though at the time they're not making a lot of money. These are like the guys of Warren Buffett. They see that, they buy that company, they turn it around, they make a whole bunch of money because they look at the balance sheet. What's it worth, right? So, two types of analysis: fundamental and technical. Fundamental about the company, technical is all about the stock, and we're going to get into that at another time.